All right, today we're talking about a really powerful financial tool for Colorado homeowners, and that is your home equity. We're going to explore how you can think strategically about this asset, especially when you factor in Colorado's pretty unique financial and, well, environmental landscape.
So, if you've been a homeowner in Colorado for a while, you've probably built up a pretty substantial amount of wealth in your property. But, the real question isn't just how much equity you have, it's about how you can put it to work strategically. How can you use it to both enhance and protect what's likely your most valuable investment? You know, the financial picture for homeowners here, it's kind of a story of two sides. It's this interesting equation that balances a really big opportunity against a pretty significant challenge. Okay, so on one side of the coin, you have the average Colorado homeowner sitting on nearly $300,000 in tappable equity. I mean, that is a massive financial resource. But, and this is a big but, on the other side, we're dealing with some of the highest home insurance premiums in the entire country. And why? Because of the very real risks we face from hail and wildfires. This tension right here between wealth and risk, that's really the core of what we're talking about today. So, the question is, how do you actually tap into that equity? Well, one of the most common and frankly most flexible tools out there is something called a home equity line of credit, or what you'll hear called a HELOC. Let's just break down exactly what that means. Okay, so the easiest way to think of a HELOC is like a credit card for your house. It's a revolving line of credit that's secured by your home equity. You get a credit limit, right? And you can draw money from it as you need it and then pay it back. The really key feature here, though, is its variable interest rate. That just means the cost of borrowing can go up or down over time. And it's really important to see how this differs from a standard home equity loan. With a loan, you get one big lump sum of cash all at once, and it usually has a fixed interest rate. A HELOC, on the other hand, is all about flexibility. You borrow only what you need, exactly when you need it. This can be a much better fit for something like a home improvement project that happens in stages. Okay, now this is where the strategy really starts to matter. Because when it comes to HELOCs, there's a very specific, very important rule from the federal government about when the interest you pay is actually tax deductible. And it all boils down to one thing: how you use the money. And listen, this isn't just some casual suggestion or a guideline. This rule comes straight from the source, the IRS. It's laid out in their publication 936, which is the official rule book for the home mortgage interest deduction. So here it is, the most important part. For the interest on that HELOC to be deductible on your taxes, you can't just use the money for anything. Things like paying off other debts or going on a vacation, that doesn't count. The rule is crystal clear. The money has to be used to buy, build, or substantially improve the same home that's securing the loan. So what exactly is a substantial improvement in the eyes of the IRS? Well, it's something that adds real value to your home, extends its useful life, or adapts it for a new purpose. Now, think about the examples here. Sure, a kitchen remodel absolutely counts. But look at the others. A new hail-resistant roof, or doing wildfire mitigation around your property. These are projects that directly tackle those high-risk, high-cost problems we just talked about facing here in Colorado. Okay, so let's shift gears a bit and look ahead. It turns out there's a convergence of economic factors on the horizon, especially around 2026, that could create a really interesting window of opportunity for homeowners who are thinking about these exact kinds of projects. So, for starters, experts are forecasting that the average HELOC interest rate could drop to around 7.3% in 2026. Now, after the higher rates we've been seeing, that would be a 3-year low, and that, of course, would make borrowing more affordable. So you've got this potential for lower borrowing costs on one side. And then on the other side, you have the potential for some pretty major savings on your insurance. Insurance companies are more and more willing to offer significant discounts to homeowners who do what are called home hardening projects, things exactly like installing that impact-resistant roof we mentioned earlier. And this is where it gets really interesting, when you see how the numbers can actually work together. Let's just walk through this hypothetical case. Say you take out a $20,000 HELOC for one of these home hardening projects. At that forecasted 7.3% rate, your annual interest cost is about $1,460. But remember, it's for a substantial improvement, so it's tax deductible. For someone in, say, the 24% tax bracket, your real after-tax cost drops to around $1,100. Now, here's the kicker. If the annual discount you get from your insurance company for doing that project is $1,250, well, you do the math. You're not just breaking even, you could actually come out ahead every year. Now, of course, that is just a model. It's an example. Turning this idea into a sound decision for you personally, well, that takes a really careful, deliberate process. The This is not about rushing into a loan. It's all about making a high-quality, well-informed choice. So here's a kind of checklist to guide your thinking. First, you've got to clearly define the project. What exactly are you doing? Second, and this is absolutely critical for that tax deduction, you have to keep meticulous records, receipts, bank statements, everything you need to prove exactly how that money was spent. Third, you need to model the numbers for your specific situation, your home, your insurance, your finances. And finally, and this is non-negotiable, you absolutely must talk this over with your own personal tax and financial advisors before you do anything.
And that leads me right into this final and very important point. Everything we've talked about here is for educational purposes only. It's meant to give you a framework for thinking through these issues. It is not, and it should not be, considered financial or tax advice for your specific situation.
So we've covered the landscape, right? This unique Colorado situation of high equity paired with high risk. And we've explored a potential strategy for navigating it. Ultimately, our goal here is just to empower you with good information. So we'll leave you with this one question to think about. Knowing that your home equity is a powerful tool, what does a smart strategy for both enhancing and protecting your investment look like for you?